that diversification is best executed with the broadest spectrum of asset types and asset classes from around the world. So each of the strategies in the portfolios that we manage are globally balanced. The next thing you need to know about us and remember is that we actively manage risk and return, and we do that around each strategy's a particular portfolio mix so that we protect our clients' portfolios during challenging markets, but we also participate when conditions are more favorable. And the result of that is we aim to reduce variability in each of our portfolios and strategies. And the third thing that you need to know about us is we focus on asset allocation. And the way that we do that, and what makes us unique in Canada, is that we use ETF securities exclusively because we believe they are the most efficient building blocks from which to construct and manage our strategies. So we are not focused on individual companies. We are focused on asset classes and asset types when we manage our portfolios. We believe that all equates to something we call stewardship. It's in our name for a reason, and we think that means treating clients fairly and always doing what we say we're going to do. Next. So without further ado, I'm going to introduce Wilfred Hahn. Wilfred is the founder of Hahn Investment Stewards. He has a long history in the category. He's well quoted, so maybe you are somewhat familiar with his views on the market. Today he's going to be discussing how to spot a bubble in advance. Hahn was founded 12 years ago as a pioneer in the ETF managed portfolio space. As of just over 10 years ago, June of 2013, we have 10-year performance track record or history for our ETF exclusive portfolios. We can provide those to anybody who is interested in seeing those. Okay, so without further ado, I will introduce Wilfred Hahn. Go ahead, Wilfred.
Hello, thank you for joining us, our webinar, participating in our webinar. The topic, as already mentioned, is a very, very topical one, covered around in papers recently. And of course, it's a very, very important one to investors. I think all of us will have seen our clients go through a number of bubble periods just in the last 10 plus years. You'll recall the technology bubble, late 1990s, and then 2006, 2007, we had the bubble in the real estate world, and that had ramifications for virtually all financial markets around the world. So it's very, very topical. Really what I want to direct my attention to is how to spot a systemic bubble. So we're not talking about smaller manias, say, such as the unit trust mania that happened a number of years ago here in Canada. We have to watch out for those too, of course. But really what we want to do is talk about the overall systemic ones. They're the most challenging and the most difficult to time, at least from a portfolio manager's perspective. So let's jump into it. What's a bubble, and why should we care? Well, I'm going to jump first here to some comments from Charles Kindleberger, who put out a very, very important book in 1978. In fact, it was building on an earlier practitioner's work back in the 1800s, a great book called Extraordinary Popular Delusions of Madness of Crowds, written by Charles Mackay. If you haven't read it, it's just a great read. It's, as you say, truth is stranger than fiction, just to hear some of the stories as to what transpired behind some previous bubbles. Now, turning my attention back here to Charles Kindleberger, just as a primer as to what's involved in a bubble, the basic diagnostics of a bubble, he came up with 5 stages. First, displacement. I'll come back to that in just a second. The boom phase, the euphoria phase, the crisis phase, and then absolute revulsion, where what had been desired before by investors en masse was no longer wanted, and they got rid of it. So let's continue on in this and look at some of these other theories. What are some of the necessary ingredients to bubbles? And I'll just mention a couple here that's common to all of them, and really I'm referring back here to what Kindleberger called a displacement. What constitutes the shock or the change in conditions that then give way to bubble conditions later? So let's just mention these 3 right here. A bubble can result when money supply and debt growth grows, or debts grow appreciably faster than savings and GDP growth. That's the most important definition. All bubbles have some version of this happening, and we definitely do see that today. Money growth, M2 already in the United States, is up to 11.2% at last count here recently. So that's certainly a manifestation of it. But remember that one, always it's money supply or debt growing faster than underlying savings and GDP growth. That sort of sets up the right conditions. And then the follow-up that you'll notice is that financial markets seem to lose their connection to underlying economies. We'll talk about that in just a second. And then us all being humans, we love an optimistic story, we love financial gains. And so that sort of lends the bias to accepting imaginative stories that sort of add to the overall bubble environment. Bubbles do have harmful effects, and not just financially, not just on portfolios. And I'll just mention here briefly, it has implications for economies at large. I love this comment from John Maynard Keynes, which is showing up here. If the enterprise of if the prime activity of enterprise is to be speculation, it leads to conditions and distortions and malformations in economies that impact financial markets later as well. So on both counts, financial and economic, bubbles we need to watch, and I'll mention a couple of reasons why. So why should we care as financial managers, wealth managers? Why should we try to spot bubbles? And bubbles, as we already talked about at the top, lead to busts. Every bona fide systemic bubble does lead to busts, and usually associated with that are currency and financial crises meaning credit crises. And there's umpteen records of this having happened in the last space of 50 years alone. There's a number of studies out on that. Around the world, there's been many tens of these systemic bubbles. So it's not like we're looking for goblins here. They actually exist, and we need to stay on top of it. The other thing that happens that's so important to us right now as wealth managers is bubbles always lead to a massive wealth redistribution. And I think some of you have already noticed that, just the way wealth is being distributed here recently. 90% of wealth gains, income gains this past 5 years since the end of the global financial crisis, have been going to the top 10%. So that's very interesting. So that's why we need to care. We need to figure out how bubbles work and how to stay on the right side of them. Well, do you believe in bubbles? Or we say jokingly here, the tooth fairy. And the reason why we joke about it a little bit is because there is quite a bit of debate on it, unbelievably. But I'd like to take you through that debate, and then I want to talk about some of the symptoms that identify whether or not a bubble is happening. Then later on, of course, I want to talk about what we can do to portfolios to insulate them against some of the risks of bubbles. Well, let's first look at so-called experts that have strong opinions on the existence of bubbles. And you'll recognize this face that we have up here right now. That's Alan Greenspan, and famously, when he was still the head of the Federal Reserve Bank, he would always say, well, you can't see bubbles in advance. You can only see them in the rearview mirror. And of course, that doesn't help us because all the damage is done by the time you're looking in the rearview mirror. Recently, just an article that came out last month in the Foreign Affairs, he admitted that he never did see it coming, and he really couldn't see it coming. So there's a prominent academician who has that kind of opinion. But he's not the only one. Quite a lot of policymakers, interestingly. I wonder why it's just policymakers that seem to have this view that there aren't any bubbles. Janet Yellen will be the new head of the U.S. Federal Reserve. She's clearly in the same camp as Ben Bernanke. In the recent testimony hearings for her nomination, she made that pretty clear, and there's some quotes that we'll show you, you'll see on your screen right now. She says she doesn't see any evidence of reaching for yield. She doesn't think there's bubble-like conditions. And she doesn't see the misalignments in asset prices. We find that very interesting. But again, most for reasons that policymakers seem to have these views. There's many others. Eugene Fama, of course, will be familiar to everybody, especially if you've been investing in the fund company that he founded. He just got a Nobel Prize, and he's even quoted to have said, in fact, that the word bubble drives me nuts. But he basically believes that markets are irrational, and he won't change his opinion on that. What's interesting as well here, just throw this in as an aside, Robert Shiller also got a Nobel Prize this year, and he holds the diametrically opposite opinion to Fama. So it's interesting that two of them, even though they have completely different views, will get a Nobel. Many others, I won't really want to dwell on this too much, But, Ben Bernanke, Paul Krugman, Larry Summers, Jim Bullard, another member of the Federal Reserve, some very, very prominent people, policymakers, all seem to have this disposition that there's no such thing as a bubble. They're mythical. They're not dangerous. Don't worry about them. But, of course, I think as financial managers, wealth managers, we do want to worry about them. Clients come to us and say, well, gee whiz, why couldn't you tell ahead of time that there was big risk in the market and that the S&P 500 would fall 50%? And as we all know, I'm just picking on one asset class there, that's happened twice in a little more than 10 years. And clients don't like to see those kinds of portfolio statements coming in the mail. And so then, I think just as a responsibility that we have to the clients, we need to try to figure these out. I'll just mention that some of these policymakers recently have come out with new prescriptions. We've already got some pretty unorthodox stuff going on in the central banking world. And they're now coming, because they're so frustrated that these new unorthodox policies that central banks are pushing aren't really accelerating economies, so they're trying to figure out what to do next. And, Summers and Krugman are actually coming out and saying, you know what we need to do? We need to get everybody into a cashless system so that we can force interest rates to go actually negative and have the banks actually charge people to have a bank account. You may be laughing, but I'm serious. That's what they're considering and floating these kinds of ideas right now. Well, let's go back to the diagnostics here. I think that's what we want to look at. What are the facts on bubbles? Well, I'm going to just list a couple of things that Keynes has said. And please don't be offended. I didn't write these. He wrote these, but the first three of these may seem a little offensive, where he identifies neophyte investors becoming more involved in parts of the capital markets, and then markets becoming highly reactive and big fluctuations and volatilities and so forth, and just the excessive influences of financial markets on people's temperament and sentiment, and also the associated change in psychology. He calls them ignorant individuals. Those aren't my words, and I wouldn't necessarily use those words. But so that's what he identifies, and he's a prominent economist, very, very influential economist. I want to focus on 4 and 5 here, and that describes accurately the kind of environment I think that we're all in right now, particularly active strategists, and that is very much of one's exercise, very much one's of portfolio investments process, so to speak, really has to now pay attention to what everybody else is thinking. So you need to have a strategy to think ahead of what somebody else is thinking, as opposed to the actual fundamentals underlying market valuations or economies. So that's very interesting. And of course, this elusive factor of confidence, point number 5, and how it impacts the credit markets. Now, we'll list next here our 5 commonalities that we see. Those are our beliefs, having read quite a number of historic economists, particularly Ludwig von Mises, a number of others. So we've distilled these over the years, and these 5 are the ones that we want to look out for. And I'll just point out some of the evidence whether or not these conditions actually exist. So let me run through this here briefly. Number 1, a large expansion in debt. As mentioned before, every time there's an expansion in debt and credit, and that sort of drives activities that kind of go to the excess, either on the overconsumption side or overinvestment side, and also financial markets. Number 2, heavy reliance on capital gains, and incidentally, you will be noticing that in recent years. You'll hear the comment now that, gee whiz, interest rates are so low, and there's no doubt about it, they are. They may go up a little bit. So what to do? You got to go for capital gains. Now, that sounds reasonable to an extent, but when it becomes an absolute vast majority of people, a mania, so to speak, that this high reliance on capital gains exists, then it becomes a little dangerous and certainly is an indicator of a bubble. Bubbles experience a high participation level in asset markets, and most importantly, they have to be assets that can be hypothecated or borrowed against. Certainly, that's what happened in the real estate bubble in the mid last decade. You have to have some kind of asset to be able to borrow money against, and we're having that this time. And I'll point those out in just a second. Always a misreading of underlying credit inflation trends. We're certainly getting that today. people are looking at underlying inflation, at least CPI inflation, saying, wow, inflation's low. But in fact, it's not, because inflation manifests itself in many ways. Consumer price inflation is only one. You have asset inflation. You can have other types of inflation express themselves in different kinds of ways. The underlying fact is always that monetary growth is in excess of savings and earnings. Number five, a great new world impulse is usually part of it. What we're really referring to here is that there's always a strong narrative that develops on something. If you look at the bubbles that happened in the late 1800s or early 1900s, it was the telephone, the automobile. Of course, lately it's been different things. It's been the technology sector and so forth. So there's big stories that go with it. The grand moderation is another big story that happened in the last decade. So I want to look next here and just identify what these stories are. What is really giving everybody the confidence that these delightful environments that we're in right now, with the equity market going up, at least in the United States, up over 20% this year, why it can continue. So I want to focus on that next, and we'll do that quickly. Very definitely, as mentioned, I'll just sum up these things. Credit and debt are growing faster than savings. There's chronic external deficits. We've got still big current accounts and so forth. I won't dwell on that too much, but that's always an important indicator. There's been some enormous shifts on households' balance sheets. Savings are again plunging. And of course, the income distribution here is changing quite significantly. And I'll show you a chart in that just a second. And that's having an impact on the financial markets overall. So where is this great impulse this time? What is the narrative that makes this current environment, or future environment, because we can't really know how long this is going to continue. What makes it such a believable story? And as mentioned, the story in the past was based on other things, real estate, new era, so on and so forth. This time it's an interesting one, and we theorize that the story this time, the strong narrative this time, is at least two things. As already mentioned, a lot of strategists and economists are saying, hey, there's no alternatives, given that rates are so low. There's no alternatives. We have to be in equities. And yes, we need to be in equities as part of a diversified portfolio, but it's the extremes of this opinion that can get us in trouble. And we'll try to get a beat on just when that point is going to be. Second thing is that this time around, there has developed worldwide and domestically a very, very, very strong faith level, if you will, in the alchemy, if you will, of central bankers. And central banks have been so influential and have coordinated their policies globally that pretty much, they've, as we call it, they've become kind of the masters of the universe. And the second thing that's happened as part of this is that macroeconomics, this past 10 years, I would say, has been elevated to science. And we all know that economics is not science. Economics is sort of the field of behavioral arts, if you will. And so that's kind of what's being foisted on us right now. All the monetary policies that are being instituted by central banks, and we're going to get a whole bunch more of these unorthodox ones in the future. They're all based on this presupposition that macroeconomic is science. And it's somewhat infectious, but we're going to point to that as being the factor that we need to deal with as part of the narrative, as the rest of the world and our clients will understand it. What happens if in each of these bubble periods, they're all different. They're not exactly the same. We pointed to the commonalities underneath them, but they're all different in some kinds of ways. And there's no really one indicator that's going to allow us to, pick that top in that bubble, as to pick whatever the pin is going to be to burst the bubble. That's virtually impossible to do, simply because we can't really guess ahead of time what the catalyst will be. But one thing that is always a good indicator to look at is sentiment. And we show you a little picture here of everybody sitting on one side of the boat, and you can see that that's destabilizing, and they could all of a sudden decide to run to the other side of the boat, and then in which case the boat's going to tip the other way. But and that of course creates quite a bit of volatility in financial terms if you look at it that way. But underlying here is sentiment, and sentiment is not just something in the behavioral arts. It's really an indicator of expressing how far people have gone to act upon their beliefs And when everybody is bullish, let's say 100% of the people are bullish, I think we all understand that that means there's nobody left to turn bullish, to be that incremental buyer out there. And that's why we need to pay very, very close attention to sentiment, which is what we do. And all of those indicators, by the way, right now are pretty extreme. So does a bubble exist now? We think the evidence is pretty clear, but having said that, it's still hard to call exactly when this bubble is going to play out or do anything else. It's very, very difficult, but we can identify the risk, and we want to pay attention to that. So why are we sure that this bubble exists? Going back to the diagnostic factors that I already mentioned, money growth. Here's a chart showing you what central banks are doing with the balance sheets. This is just 4 of them, the 4 major ones. And it's incredible. It's incredible how far they've expanded their balance sheets. So that very, very definitely is the monetary impulse behind bubbles, whichever way they express themselves. And by the way, if you take all the central banks in the world and combine them together, combine all their balance sheets together, they are now equivalent to the size of 1/3 of the entire value of the world economy, annual output, that is. Never happened before, and it clearly tells us that we're in a different environment, and most certainly these factors are impinging on the current bubble environment. Another fact of the current environment, low interest rates. We all know that. But you can see that the major central banks have oppressed rates now for a period of 5 years, and in many cases very close to the zero bound. And that's, of course, I think all of us know, is heavy on the mind of our clients who are looking for income, but where can you find it when interest rates that low? So deliberately, central banks are trying to force everybody up the risk curve. Now, no doubt the question is going to come, well, where's all this money going? Where is it manifesting itself? And, one of the things that's different this time, it's not manifesting itself in a way that the average investor is going to realize. When the real estate markets were boiling in the mid of the last decade, of course, everybody could see that. But this time around, aside from stock markets going up, and of course some of that incline over the last 5 years has been deserved, but this time around it's not so evident. Central banks, at least I'll just focus on the U.S. Central Bank, they have an excess reserve of $2.2 trillion. So that's sitting on banks' balance sheets, earning no income, and these banks have to do something with it. They can't just sit on top of 2.2 million and not earn any income. And so that's where some of the excess is here right now. And again, private investors are not going to see this. Central banks, not central banks, but commercial banks, have really levered themselves up in the swap markets and rehypothecating these assets. It's quite a bubble there. And you will have noted in the middle of this year when interest rates went up a little bit, things slowed down in an awful big hurry. And that's simply because these banks have exposures like this, and economies are pretty sensitive. Another area where a lot of this cheap money is having an impact is on the leveraging in the hedge fund sector. So what we're showing you here on this chart, if you look to the far right column, you'll see end of September, basically the whole hedge fund sector, that's global, is now at a 5 times leverage. So they're happily using a lot of this money, and we all know that you can make a lot of money leveraging, but if the trend goes against you, it also means that there's a pretty vicious downside. So we got to pay attention to that. So if you look at the change in that condition over the last 4 years, without a doubt, investors have been happily going down the leveraging route, and it's great while it lasts, but it does add a little bit of a unstable factor here as to when, how violently things can change if they do change. One thing I want to point out, I'm just going to rush along here, but one of the things that's also different this time around that seemingly isn't getting too much attention is that we have the velocity of money falling very, very rapidly. And that has an implication for valuations overall, so that's one of the dangers that I think some strategists are falling into, is saying, well, you know what, markets are expensive, but maybe they're not as expensive in 1999. But that presumes that everything's the same here in this year as it was in 1999. And we're pointing to this chart here and saying, no, things are very, very different. And this is one of the reasons why valuation should be lower than others. And one last indicator here, I believe, is that we clearly are seeing sort of a two-economy type of environment, and that's a symptom, in a sense, of bubble environments too. and that is gains and income gains and capital gains are really accruing to those who are already wealthy, and you certainly see that in the different performance of various retail sectors here. So you look at the luxury goods suppliers, they're doing one heck of a lot better than the more generic department store chains. And just to top up that analysis, here we are. You know, we talked earlier about one of the indications of a bubble period being that the underlying economy seems to be somewhat detached from what's happening in financial markets, and you can see that here. All the while that personal income growth has been falling, and even negative in real terms, financial markets have been doing the very opposite. So that's an interesting condition. Well, okay, you know, who are you going to call? We've determined that very likely we're in a bubble period. It can continue for a while. So what are we going to do about it? And we can tell you what we're thinking. But I want to mention first one of the realities of the pressures of the business that we're in. It's never nice to suggest to clients that risks are getting higher or high and that we need to pay attention to risk. As mentioned earlier, it's a basic human condition that we all like bullish stories, including me. So we're not, we're not happy Ghostbusters here. Interesting comment from John Kenneth Galbraith, a Canadian economist, and he was commenting on the 1920s, and this is precisely that whole issue. Who really wants to put a pin into the bubble? Nobody. And so that's a bit of a challenge for us as an industry, but I want to point to the reasons why we must do so. And as investment managers, our fiduciary responsibility, we believe, is to act in the best interest of our clients. And we feel we must do that by following our own research and disciplines that we've developed over the years and just stick to it, even when clients want to disagree with us. So sometimes that'll make us the odd man out. But I can think back to, I think I've been through 5 big bubbles, and each one of them is just horribly difficult from a psychological level. And if you're trying to protect clients from these late stages of a bubble, even though we can't pinpoint them exactly, it's really tough to do. But always clients have thanked us afterwards, even though we might be early. We're early this time again. We're taking risk off the table. But after the fact, clients have always been thankful that we paid attention to risk. And we'll just have to see how it turns out this time as well. If you think of some of the really famous asset managers like Buffett and others, they all have been very, very good at resisting psychological hazard. And so that's what we feel we need to do. So there's no question that risks are getting higher in portfolios in financial markets, and we need to pay attention to them. And what we've been doing to insulate portfolios, I'll tell you here in just a second. But I did want to make a point here before we do so, that bubbles very much are being viewed differently by asset managers today. It used to be that it was our prime job to run from bubbles because they seemed to be dangerous. But today, pretty much when we're in the slow growth world, asset managers, certainly hedge fund managers, feel that they need to be right in the middle of that storm, of that bubble, if you will, because that's in this sort of zero-sum low growth world, that's a very good investment strategy. So it can be, but it's also highly, highly dangerous, just like chasing storms. You might be caught. So what are we doing? And I'll come to a conclusion here. First off, we need to understand risk. We always talk about that. Risk is the most important thing that we try to quantify and the price for it. I think back to 2007, people at that point in time were willing to pay extra to take on risk. It should be the other way around. You should be able to get it for a good price. We need to stick with a proven investment process, and that's what we're doing. We're not changing. We need to buy insurance, and that's what we have done. The problem with insurance, if you hold it for longer periods of time, you keep paying the premiums, but it's not paying off. But that's sort of the price of insurance, and that we continue to build insurance type positions into our portfolios. Focus on income. I think that's a good thing to continue to do as part of an overall diversified portfolio. Our portfolios, on average, have a yield that's about 50% higher than the benchmark for each of the portfolios. So that's the approach we continue. We have been raising cash. We've been very careful about it, though. If this would have been 2007 or 2008, we probably would be up at 25% cash, which we were in those days, and also in the late 1990s. But today, with interest rates being so radically low, it's really, a lot more treacherous to have high cash positions. So we haven't been as aggressive on that, but we're up around 6 to 7%. And as long as these bubbles continue or the valuations start to get higher, we'll be raising it more. And the final comment here is that we need to be patient and realize, of course, that the specific catalysts that bring these periods to an end are very, very difficult to forecast. And often what happens is something entirely unrelated creates the change in the sentiment overall that brings an environment where diversified portfolios will have paid off. And what's the end result for our for bubble watchers, if you will? Our portfolios have earned a reputation for lower drawdowns. When the bad environments come, we've always done very well in those environments, and clients have appreciated it. And that's added in a material way to our long-term record of outperformance, even though within that long-term period, now over 10 years in terms of the CTF portfolios that we're running now, we have nonetheless still had a stellar long-term performance, even though we've become, we watch out for these secular bubble-type periods. So at the end of the game here is that I think we're gonna continue to deliver better experience for our clients over the long term, and I think we'll earn some great credibility with our clients. So thank you very much.
Thanks very much, Wilfred. Some great insights there. I'm sure it'll generate some good questions. As you can see, we're not afraid to have our convictions. I'm going to take a couple of minutes and take you through the final segment of the presentation, talking about the efficiency or tax efficiency of the Hahn managed ETF portfolios. And so again, a lot of this relates to the customized environment that we offer. And what that does is it confers some special tax advantages to our clients. So I'm going to start. I will take you through the individual cost base of the separately managed account. We'll also talk about fee deductibility, our investment management fees, and how we effectively and efficiently harvest tax losses using ETFs. And then we'll talk a little bit about the ETF structure itself. Okay, so personalized investing, we like to talk about that, and we believe that's an integral part of stewardship. What does that mean? To us, it means discretionary portfolio management in a separately managed account structure. And what is discretionary management? As you can see there, it's a service. It is provided by investment professionals or managers such as ourselves who have met the highest standards for proficiency, experience, and such. As Wilfred mentioned earlier in the presentation, we are fiduciaries. What that means is we act for the exclusive benefits of our client, and we are required to disclose any and all conflicts of interest or potential conflicts of interest. How discretionary management is distinct from, say, the advice world is we do not liaise regularly with clients on an ongoing basis before we make adjustments to their portfolio. What they've done is they've delegated that responsibility to us as discretionary managers. So we have the ongoing oversight of each of their portfolios. So next we're going to discuss separately managed accounts and what they are. And separately managed account is the highest form of account supervision that individual investors can avail themselves of. And what it essentially means for the purposes of the tax efficiency that we're going to be talking about is each client has an individual portfolio or separately managed account. Sometimes you may also know them as segregated accounts. And why that is important is that each client has their own individual cost structure and has their own cost base for each security in that portfolio. So this is a very personalized environment. It is evolving rapidly. Wilfred's founded Hahn with the intent of effectively democratizing this very high-value, sophisticated form of investment management. And that's a good segue now to how do financial professionals work with Hahn. And you can see in this particular slide how that works. So on the top left quadrant, financial professionals, we work with a number of financial professionals. And the ones that tend to want to deal with us have taken more of a specialized approach to their practice and their business. And we think they're very forward-looking people, and we currently deal with people who are retirement income planning specialists, they're estate planning specialists, insurance planning specialists, or tax planning specialists. But a key feature of many of the advisors that we work with, or referral agents, or financial professionals that we work with, is they've chosen to focus on a particular area of specialization. Now, what allows them or enables them to do that is they are increasingly outsourcing asset management. And this is good. This is, you see the Hahn over there on the right. This is what it looks like. So our role as discretionary portfolio manager is to help clarify the client's goals and investment objectives. And then what we do is we select together a strategy that we think is most appropriate for achieving those goals and investment objectives. And then we manage those on a discretionary basis. Now, at any time that an advisor wishes to speak to us, by all means, we are happy to speak to them, clients as well, as they are technically our clients from a regulatory perspective. We then track and communicate their progress against those goals or investment objectives that we've agreed on mutually. Now, the other party to the room in this environment that helps envelop the client, and again, this is about stewardship, so we're very client-centric, and that's why we put the client at the heart of the model there, is you will see a custodial bank, or you know them as custodians. And obviously there's some and several custodians, but the main task or function of a custodian is they are what is known as book of record. So they are the official record keeper, and they hold the securities, and they administer those securities that we have. Now, the important point that I need to bring up about the custodian is that the custodian is there for the client's protection, in that at no time does Hahn have access to the client's assets. In fact, cash flows to and from the separately managed account of the portfolio are handled directly with the custodian. However, when a client signs on with a Hahn, what they do is they confer trading authority to Hahn. So we can reach into that portfolio and make those ongoing adjustments on their behalf based on that agreed upon strategy that we've selected. Now, as book of record, official statements come directly from the custodial bank, and they are also responsible for any and all tax reporting. So there's regular and ongoing communication here, and we like to say that this process works when we understand the strategies, when we understand our clients' priorities and they understand our strategies. So here, let's get into the tax advantages, and I think most everybody recognizes that having an individual portfolio is significantly different from pooling of assets, which is typical in the, say, mutual fund or pool fund world, because the client has their own individual cost base or tax base. And everybody's familiar, I think, everybody who's been in the industry for any length of time is familiar with the November purchase decision. Do I make purchases in my client's mutual fund in the month of November? And are they going to experience some unintended distribution year end? And that usually involves phoning a particular fund company and trying to get an estimate of the size of the distribution and the composition of the distribution. And as you know, distributions are not just capital gains. They can be dividends, and they can be maybe least attractive interest income as well. So that's the first advantage of having a separately managed account, is that we can, because we have a separate cost base, we can manage around these situations on a more customized basis. Another thing I'll mention briefly is that if a client of ours has assets elsewhere and they have a tax situation elsewhere that they need to offset, we have the ability to do that on a selective basis as well. So the second advantage of our particular account structures you see here, in Canada, fees are charged, when fees are charged to non-registered accounts, the investment management fee is tax deductible, and that's against any income. And the CRA does allow these amounts to be deducted, again, from any source of income, as long as it's not in a registered account. You know, by comparison, as you realize that the fees charged inside a mutual fund or a pool fund are not directly deductible on an annual basis against those fees. So here's a particular example. It's a very simplified example, and you see on the left we've used a sample, a very typical situation where we deal with an advisor here where our investment management fee may be 80 basis points and the referral or distribution cost is 1 basis point $500,000 portfolio, you can see the result there in terms of the effect of the tax deductibility of our management fee. It can be significant if the client or your client is in the highest marginal tax rate. The other thing obviously to mention is we're not in mutual funds. There's no DSC, so there is no fly paper. And that's another salient benefit of an SMA. Because the client owns the underlying securities, there's complete accountability. If for whatever reason somebody becomes disenchanted with Hahn, those securities are completely portable. They do not need to be sold. They could be another manager could be replaced. So that's another level of accountability that this structure brings to clients. The third advantage of the ETF portfolios is you can see a typical example. When somebody's focused on individual securities and they wish to harvest harvest tax, you can see their alternative is they can either wait 30 days so that it's not to trigger CRA's superficial loss rule, or they can buy a different security in the same category, obviously an imperfect solution. Our advantage is that there are about 5,000 ETFs, and we have actually have a particular expertise. I'd like to say that we've analyzed all of them. Obviously, we were helped because we have a screen that takes out some of the impurities that we're not particularly fond of. But and we've had recent examples of where we've realized some of the losses, and Wilfred had mentioned earlier we had some gold exposure, and we were able to do that on behalf of our clients. I think the main benefit of this advantage is there's absolutely no surprises. We do not, because we see the portfolio on an ongoing basis throughout the year, we do not have to guess at what distributions or what tax event they may be come November or December, and we don't need to speak to anybody. We can see that. It's plain to us each and every day. And therefore, the final advantage relates to the ETF structure itself. Obviously, in an actively managed mutual fund or pool environment, it creates turnover, which are taxable events. So they can be, let's say, less tax efficient than our particular structure. ETFs are largely based on a predetermined a package of assets or a benchmark as such, and as such, lower turnover. And as I indicated earlier in our screen, one of the things we look for is we look for ETFs with lower turnover that have lower management fees and such. And the final feature of the ETF structure is their unique redemption and creation process. And without deep diving into this, because this would, if we fully explored this topic, it would certainly be well outside the scope of this particular presentation. But when an ETF company wants to create shares in its funds to meet new demand, they turn to an authorized participant. And without getting too deep into this, the authorized participant works on the stock exchange, and it's their job to acquire the securities that the ETFs wants to hold. And again, that's a much larger topic outside of the scope of this presentation. So to recap, ETFs and what we do in a separately managed account using ETFs manage on a discretionary basis. There are certain advantages that confer to our clients. Individual cost base, obviously, is a big one. Fee deductibility of the investment management fee, and the effective way in which we can handle tax loss harvesting without compromising our portfolio mix that we have for any particular strategy. And finally, the ETF structure itself with lower turnover and that unique creation redemption process. So you add all this up, we believe very strongly it supports our promise of stewardship, personalized investing, and specialized expertise. And it is one of the reasons why we believe that there's going to be a huge shift towards outsourced asset management. I'll give you a couple of statistics. There's a company out of New York called Strategic Insight, and a man who runs it, Dave Nakmani, who will tell you that discretionary management is the fastest growing form of account supervision post-crisis in the U.S., and that is largely because people want to delegate those decisions. They want to remove the emotion from the process, and there's no better way to do that than to outsource asset management to somebody who's a specialist. We It's not, asset management, as Wilfred has indicated, is not something you want to be doing off the corner of your desk, and probably much less so in future. It is the only thing on our desk, and it frees you up to become the specialist that we believe you'll need to be in future in order to compete. So the other thing I will mention in terms of statistics, we have reports from Cerulli Associates and also from Morningstar that show that what we do, and what we do is, the category is well, unofficially named ETF strategists. We are the fastest growing form of fastest growing class of asset managers in the U.S. And we believe that trend will migrate to Canada, and believe it's already in fact started. One other final statistics for you, for those of you who have access to Investor Economics Insight and their report. If anybody's seen the most recent household balance sheet, 2012 to 2022 projections, Investor Economics are projecting total wealth in Canada to grow by 5.7% compound average annual growth rate, and that compares to 9% discretionary management. So you can see that discretionary management, according to Investor Economics, has a bright future. So that's sort of the basis of our formal comments. We'll turn it over for questions at this point. Okay. Where do you want to? Can you blow that up so it's the whole screen? Okay. I'm going to state the question first.
Okay. We live? First question, I'll read it. With central banks devaluing the currencies around the world, are hard assets, commodities, and equities the only store of real value for the future? That's a good question. Everybody's pondering that these days, and many are, of course, coming to the conclusion that that equities is the answer. Commodities in the recent year haven't done that well. Cyclically, of course, have had some pressure, but longer term, if we get, there's a number of provisos here. If we get what we call a crack or boom environment, then very, very possibly commodities themselves will be more increasingly seen as a hard asset. Gold historically has always been the asset that seemed to be the sentinel of eroding financial wealth through what we call monetary malfeasance. Now, as everybody knows, gold hasn't done very well this year. Probably a number of reasons why that's the case. However, that would be a different question. We still think that you need to have diversified portfolios, and that means you do need to have some gold. And our portfolios continue to hold some gold. We don't have huge positions, but nonetheless, given the kinds of environment, kind of possible scenarios that can play out, we do need to anticipate those environments, and therefore we would also have some gold. One last comment with that. I do believe that we increasingly need to think about relative performance. And why I say relative performance, it's not in the sense that we want to benchmark ourselves against everybody else. It's relative in the sense of real returns. And I mentioned earlier the possibility of us getting into an environment where there's negative real rates. Well, we've had negative real rates for a period of time, but we may also get negative nominal rates. You listen to some of these policymakers, and in that kind of a world, where we're kind of dealing with an upside-down return structure, then it becomes more of a relative game. And let's hope we don't get in that kind of environment. But I do think we increasingly have to start thinking that way. Trying to do the best we can, no matter whether asset classes are going up in price or not. Another question here. These are real challenging questions. I'll read it. What are your thoughts about what will happen when QE ends, and what is your strategy at that time? There's a lot of texture here to this question. And firstly, what is QE? And QE is something that itself is morphing and changing all the time. We have written a couple of articles, and I certainly welcome everybody to access our website to read them, on what we call this new policy development, OPMF. That stands for Overt Permanent Monetary Finance. I know that sounds boring, but basically what that's all about is central banks, and I think in the case of the Federal Reserve Board, they're already doing it. What they're doing is they're buying government treasury bonds, and effectively may never, ever sell them. In fact, they may forgive the debt. And so this OPMF is actually a policy which suggests that central banks should be financing governments directly. In other words, not through treasury bond markets, but directly financing governments. And believe it or not, there's quite a number of academics, and we think it's an increasing trend, that are leaning towards this as a policy that must be pursued. So please go read that article. And that changes the dynamics completely. And it could very well mean that that even though economies are highly interest rate sensitive, that they can continue to manipulate interest rates sometime longer. So it's not an easy question, but again, I'd refer you to those articles.
Last question.
So I believe we have time for one last question. Question here is, do you want to short the index? Presume that's just the overall market index, equity market index, when the bubble pop becomes obvious or begins to happen. First thing to say is we are a long-only asset manager, always have been. We've never entertained shorting or leverage, simply because of the risk dynamics that entails. Other managers may be good at it, but we have always been a long-only diversified portfolio manager, and so we wouldn't be shorting any index. But I would also add that one of the dynamics of the kind of financial markets that we've been in expressly this last, let's say 6-7 years, is that when the tide turns, it's very, very difficult to move around in those kinds of environments. It certainly was in 2008. And you really have to be looking at these things in advance. I think the only reliable way of doing it, even though timing is always difficult, is to assess risk and to adjust risk in portfolios. And when we see risks going higher, we have to adjust it down. So as opposed to specific timing, because I don't think you can do it reliably anyway to get these bubble tops. You just need to respond to the facts that you have on the table and the consistent investment process.
Okay, so we have a number of excellent questions there, and unfortunately we've come to the end of our allotted time here. I would urge you to speak to, if you have any more comments, questions, if you're looking for information, performance, any of that, please speak to, you can see the the left-hand box there, information, you can email us. I urge you to speak to Wilfred as well. He's very, very friendly and approachable. We're happy to speak to you directly, and you can find the phone numbers there. Wilfred mentioned earlier our new website. We would suggest you go there. You will also see one of the panels on the new website where you can sign up for Hahn Thinking, and that's a good way to stay abreast of how we're viewing capital markets and what we're thinking, what we're doing, and what it means for you. Thank you very much for your participation in this seminar. We'll send notification of the next one, and we will also post this particular seminar online very shortly. Thank you. It's okay?
Perfect. It's done. That's amazing.
Microphone's dead?
Yeah.
Okay.
Sorry?
Yeah.
You got really going there.
Well, I was looking at the clock, and I said, I better get on my horse
That
here.
was good. No, that was good.
All right.
They went a little
Perfect.
longer than
I just kept getting